Hi, this is Darshan Bhatt from Glovista Investments with our market outlook for the month of February. The start of 2022 has witnessed one of the sharpest declines in risk assets in the recent financial history, with the S&P 500 index declining by 5.57% and the Nasdaq index declining by 9.96% for the year-to-date period, despite the bounce in the past week. The market sell-off has been driven by an unambiguously hawkish commentary out of the US Federal Reserve, as well as adverse growth-related concerns emanating due to acceleration in higher energy prices, and number two, rekindling of the supply chain-related issues out of Asia. Such macro and policy developments have led to a tightening of US financial conditions and in adverse implications for expensively valued growth-oriented sectors and markets versus their cheaply valued value peers. For example, within the large cap value space as represented by the S&P 500 Value Index has outperformed the S&P 500 Growth Index by more than 7.4% in the year-to-date period. As we look ahead, we believe the financial conditions will continue to tighten further as the sovereign rate curves continue to flatten. The interest rate volatility will continue to remain high as the economic growth momentum decelerates further on account of tax hike-like effect of energy price inflation. In addition, Asia's zero tolerance COVID policy implies a longer-term relevance of supply-side related cost-push inflation as the region continues to battle the Omicron virus. From a financial markets perspective, the financial markets are currently discounting more than 5 rate hikes on the part of US FOMC within the US. Similarly, some of the other developed market central banks have recently adopted a hawkish stance, including the Bank of England that has already raised interest rates by 0.5%, and recently the European Central Bank potentially indicating a 2 rate hikes of 0.25% later in the year. We believe in due course, the potential for deceleration in economic expenditure on account of higher energy prices and a potential deceleration in inflation dynamics in the second half of the year could lead to a more cautious stance by the Federal Reserve on the policy rate path. In the meantime, though, the value-oriented sectors and markets will continue to outperform their growth-oriented peers. From a portfolio perspective, we continue to remain the energy, financials, and materials sector, along with select high-quality large-cap growth peers. We also prefer emerging market equities, which looks poised to solidly outperform its developed peers in 2022, driven by markets' rekindled focus on valuation. Number two, emerging markets' superior earnings and revenue revision dynamics. And number three, resilience of the currency supported by adequate FX reserves, stable current account positions, and interest rate differentials, which are positive compared to the US dollar. From a macroeconomic perspective, the market's focus over the next few weeks will continue to be on inflation-related releases globally and the potential impact that it could have on the central bank's interest rate path. Meanwhile, the markets could remain volatile as it adjusts to these expectations. Thank you for listening and good luck.